Okay, let's dive right into this explainer. Now, if you look at traditional, standard corporate structures, the rule of the game is pretty simple, right? The more capital you inject into the company, the larger your slice of the profits. Your power and your payout are basically directly tied to the weight of your wallet. But what if we completely flipped that script? What if a business rewarded you not for what you passively invested, but for how actively you participated? Today, we're going to contrast standard corporate profits with a really fascinating, highly equitable solution found in cooperative accounting. Specifically, we're looking at something called the patronage refund. Here's our quick roadmap for today. 1. Defining the patronage refund. 2. Core characteristics and rules. 3. Real-world cooperative scenarios. 4. Mixed distribution strategies. And 5. The accounting mechanics. Before we get into any of the heavy math or the accounting ledgers, I really want you to internalize this one quote. Members benefit in proportion to their participation. It's absolutely crucial. In the cooperative model, investors don't win based on capital hoarding. They win based on use. It's just a radically different way of looking at a business's relationship with its community. All right, let's kick things off with Section 1, defining the patronage refund. So what is it exactly? Well, a patronage refund is, at its core, the distribution of a cooperative's net surplus right back to its members. But here is the critical distinction we need to make. It is based strictly on their use or patronage of the cooperative services, absolutely not on their capital contribution. The money is moving entirely based on a member's active, everyday participation with the business. Literally, if you buy more, if you sell more, or if you use the services more, your slice of the surplus grows. Moving right along to Section 2, Core Characteristics and Rules. There are 4 main guardrails keeping the whole system on track. First, it's strictly based on transactions with the cooperative. Second, and actually this is massive for the accountants out there, it's declared from the net surplus, not as an operating expense. Third, these aren't just arbitrary payouts decided by executives behind closed doors. They absolutely must be formally approved by the General Assembly, the actual governing body of the members. And finally, number 4, it doesn't always come back as pure cash. It might be distributed as share capital or even a mix of both. Okay, Section 3, Real-World Cooperative Scenarios. Let's see this in action. It's really fascinating to see how a member's everyday activities add up. Meet one. He's a member of an agricultural cooperative. Over the year, he bought fertilizers and seeds totaling 40,000 pesos, and he used the cooperative's tractor services for another 10,000. So combined, Juan has created a 50,000 peso total patronage footprint. Now, how do we translate that 50,000 footprint into an actual refund? Pay close attention to the denominator here, the 500,000 total cooperative patronage. This is the sum of every single transaction from every single member in the entire co-op. We take Juan's 50,000, divide it by the total 500,000, and that proves exactly how Juan earned his specific 10% share of the pie. The cooperative has declared a total patronage refund pool of 50,000 pesos, so we just multiply his 10% by that declared refund, and boom, here is the satisfying reveal. 10% of 50,000 is 5,000. Juan's active participation yields a direct return of 5,000 pesos. Think about that. He just used the cooperative services to farm his land like he normally would, and simply by doing so, he earned a substantial cash return at the end of the year. And this brilliantly illustrates the exact same principle, but let's look at a fisheries cooperative this time. Here, a fisher member isn't just buying stuff, they're also marketing through the cooperative. So let's say they sold fish through the co-op totaling 80,000 pesos, and they utilized the ice and cold storage services for 20,000. Add those together, and their total patronage footprint sits at a neat 100,000 pesos. The mechanics remain wonderfully consistent. In this scenario, let's say the entire cooperative did 1 million in total patronage. Again, we just divide their individual patronage of 100,000 by the 1 million total pool. That gives our fisher member a quick 10% slice. And let's assume the total refund pool declared by this cooperative is 100,000 pesos, which perfectly lands our fisher member a 10,000 peso refund. 10% of the 100,000 pool. It proves once more that rewards scale directly with use. The more fish they sold and the more cold storage they used, the larger that final refund became. Now let's look at Section 4, Mixed Distribution Strategies. In this scenario, a member has done the math and they are officially entitled to a 6,000 peso refund based on their patronage. But the General Assembly has approved a mixed distribution policy. It's not all cash. The policy mandates a strict 50-50 split. Half will be given in cash, and half is going to be directed into share capitalization. So how does that break down? It's 3,000 pesos of cash directly into the member's pocket, and 3,000 added to their capital account within the cooperative. Honestly, this is a brilliant retention and growth mechanism, because by injecting that 3,000 back into share capital, it actively strengthens the financial foundation of the very cooperative that serves them. The member builds long-term wealth, and the cooperative builds operational stability. It is just a perfect symbiotic loop. All right, last stop, Section 5, the accounting mechanics. We're following the CDA, or Cooperative Development Authority, aligned rules here. We must sharply contrast this because it is a very common point of confusion. Remember, a patronage refund is a distribution of surplus. It's literally the money left over after the business is operated. Meaning it is fundamentally incorrect to record this as an operating expense. You absolutely do not record it as a cost of doing business. The correct treatment? It must be deducted directly from the undivided net surplus. The timeline is also incredibly important here. The second this refund is officially declared by the Assembly, it is immediately recognized as a strict liability. It isn't just a theoretical promise anymore. It becomes a legal obligation to the members. The cooperative now owes this money to its participating patrons. For the accountants and financial officers listening, here's your bread and butter. This translates to a very specific two-step journal entry. Step 1, you debit the undivided net surplus. This properly reduces the cooperative's retained earnings. Step 2, you credit the patronage refund payable. This simple two-step entry ensures the surplus is properly reduced while officially booking the payable on the balance sheet. You are basically shifting the funds from the cooperative's equity directly into a liability account earmarked specifically for the members. Which brings us to the ultimate takeaway here. Standard businesses might just reward the highest bidder, but cooperative accounting fundamentally rewrites that rulebook. As we wrap up this explainer, I really want you to ask yourself, how does your active participation shape the value of your community? Because as we've clearly seen today in the math and the ledgers, the patronage refund proves that equitable participation quite literally pays off. Thank you so much for joining me on this explainer, and keep exploring how structured systems like this can drive fair outcomes for everyone.